The impact of economic policies on personal finance. Ever wonder how decisions made in far-off capitals impact your piggy bank? We'll break down major economic moves and show how they can swell your savings or sink your stash. From interest rates to regulations, get the lowdown on levers, governments pull that payoffs, or pains, end up in your wallet. Understanding economic policies. Before we delve into the details, let's start with a fundamental question. What are economic policies? In a nutshell, economic policies encompass a range of measures implemented by governments and central banks to manage and stabilize the economy. These policies aim to regulate various aspects, such as fiscal policy, monetary policy, and trade policy. And guess what? Each of these policies has a direct impact on our financial well-being. Let's begin by understanding the different types of economic policies and how they influence our finances. Fiscal policy. Fiscal policy is a term used to describe how governments utilize taxation and public spending to shape and influence the economy. Within fiscal policy, taxation plays a pivotal role in impacting our finances. Tax policies, including income tax rates and deductions, can have a significant effect on our disposable income. When tax rates change, it directly affects the amount of money we retain. For example, a decrease in income tax rates can put more money in our pockets, providing a welcome boost to our financial situation. With increased disposable income, we have the opportunity to save more, invest in our future, or spend on things that hold value for us. Tax deductions also play a crucial role in fiscal policy. They can reduce our taxable income by allowing us to subtract specific expenses or contributions from our overall earnings. By taking advantage of deductions, we can lower our tax liability and potentially increase our available funds. Understanding how fiscal policy impacts taxation empowers us to make informed financial decisions. It allows us to adapt our saving and spending strategies in response to changes in tax policies. By staying informed and aware of tax rates and deductions, we can optimize our finances and make the most of available opportunities. Monetary policy. Monetary policy is a vital tool used by central banks to manage the economy. One of the key components of monetary policy is the control of interest rates, which directly influence borrowing costs and savings returns. Let's delve into this topic and explore its impact. Interest rates play a significant role in shaping the economy. When central banks lower interest rates, the cost of borrowing money becomes cheaper. This can stimulate spending and investment, as individuals and businesses find it more attractive to take on loans. Lower interest rates can incentivize consumers to make big-ticket purchases, such as buying homes or vehicles, while encouraging businesses to invest in expansion and innovation. However, the impact of lower interest rates on savers can be different. As borrowing costs decrease, returns on savings and deposits may also decline. This means that individuals who rely on interest income from their savings accounts may experience reduced returns. It's important to note that savers may need to explore alternative strategies, such as diversifying their investment portfolio, to seek higher returns in a low-interest rate environment. Conversely, when central banks raise interest rates, borrowing becomes more expensive, which can moderate spending and investment. Higher interest rates may encourage individuals to save more and discourage excessive borrowing, helping to control inflation and maintain financial stability. Understanding the influence of interest rates and how they are managed through monetary policy allows us to make informed decisions regarding borrowing, saving, and investment. It helps us navigate the economic landscape and adapt our financial strategies accordingly. Inflation and price stability. Now let's shift our focus to another critical element of economic policies: the management of inflation and the maintenance of price stability. Inflation refers to the gradual increase in the prices of goods and services over time, which can erode the purchasing power of our money. Understanding how economic policies address inflation is essential for our financial well-being. Economic policies are designed to play a vital role in managing inflation. When inflation rates are high, our savings and our ability to purchase goods and services are at risk. Governments and central banks implement policies aimed at controlling inflation and ensuring price stability. These policies can include measures such as adjusting interest rates, implementing fiscal policies to manage aggregate demand, and closely monitoring and regulating the money supply. By employing these strategies, economic policymakers aim to strike a balance that promotes stable and sustainable economic growth, while keeping inflation at a manageable level. This is crucial for maintaining the value of our money over time and protecting our financial interests. Understanding the role of economic policies in managing inflation empowers us to make informed decisions regarding our savings, investments, and overall financial planning. It allows us to navigate the economic landscape with greater confidence and take steps to mitigate the potential negative effects of inflation on our finances. Impact on investments. Having explored important elements of economic policies, let's now delve into how they impact our investments. Economic policies have the potential to significantly influence the performance of various investment vehicles, including stocks, bonds, and real estate. Understanding these dynamics is crucial for building a resilient and successful investment portfolio. Economic policies can directly impact investments in multiple ways. For instance, changes in interest rates can affect the attractiveness of bonds, as higher rates may make existing bonds less desirable compared to newly issued ones. Additionally, fluctuations in interest rates can impact borrowing costs for businesses, which can influence their profitability and, in turn, affect stock prices. Furthermore, fiscal policies that prioritize infrastructure development or provide incentives for specific industries can create investment opportunities in sectors such as real estate or renewable energy. By staying informed about economic policies and their potential implications, investors can make more informed decisions and capitalize on emerging trends and opportunities.
Keeping a pulse on economic policies allows investors to understand the broader economic climate and adjust their investment strategies accordingly. By staying informed about changes in fiscal and monetary policies, as well as economic indicators, we can navigate the investment landscape with greater confidence and adapt our portfolios to optimize returns and manage risks. Global economic policies. While we have primarily discussed the impact of domestic economic policies on personal finance, it is essential to recognize the significance of global economic policies in today's interconnected world. International economic policies, such as trade agreements or currency exchange rates, can have a profound ripple effect on our financial lives. Changes in international trade policies can directly impact our finances. For example, alterations in tariffs or import-export regulations can affect the prices of goods we consume. If trade barriers are imposed or lifted, it can lead to fluctuations in the availability and cost of imported product. These changes in prices can have an impact on our budget and spending habits, potentially requiring adjustments to our financial plans. Currency exchange rates are another crucial aspect of global economic policies that can influence personal finances. Fluctuations in exchange rates can impact the value of currencies when we travel or conduct transactions in foreign markets. Moreover, if we have investments in foreign countries or hold assets denominated in different currencies, changes in exchange rates can affect their value, potentially impacting our investment returns. Staying informed about global economic policies and their implications is essential for managing personal finances effectively. By understanding the potential effects of international trade policies and currency exchange rate fluctuations, we can make informed decisions regarding our consumption patterns, investment strategies, and overall financial planning. Adapting to economic policies. Now that we have gained a comprehensive understanding of how economic policies influence personal finance, let's discuss how we can adapt to these policies to secure our financial well-being. To navigate the impact of economic policies, it's crucial to stay informed and proactive. Educate yourself. Stay updated with current economic news and policies. Read reputable financial publications, follow reliable sources, and consider consulting with financial advisors to stay ahead of the curve. Budgeting and planning. Take into account potential changes in taxes, interest rates, and inflation when creating your budget and financial plan. Be prepared to adjust your spending, savings, and investment strategies accordingly. Diversify your investments. Spread your investments across different asset classes and geographic regions. This diversification can help mitigate the risks associated with economic policy changes. Stay flexible. Economic policies can be unpredictable. Be ready to adapt and make necessary adjustments to your financial plans as circumstances evolve. Gaining an understanding of how economic policies impact personal finance is crucial for making informed financial decisions. It allows us to adapt to changes and navigate the ever-evolving economic landscape, ultimately securing our financial future. Staying informed about economic policies, both domestically and globally, empowers us to make educated choices regarding saving, spending, investing, and borrowing. By staying up to date with changes in fiscal and monetary policies, trade agreements, and currency exchange rates, we can anticipate potential impacts on our finances and adjust our strategies accordingly. In addition to staying informed, seeking professional advice from financial experts can provide valuable insights and guidance. Financial advisors can help us navigate the complexities of economic policies, offering personalized strategies that align with our goals and risk tolerance. By combining our knowledge of economic policies with professional advice, we can make sound financial decisions that optimize our financial well-being. This includes managing our savings, investments, debt, and overall financial planning in a way that accounts for the dynamic nature of economic policies. Hope your wallet's feeling wiser. Show us some love by smashing that like, join our coin crew, and educate any economically ignorant amigos of the real impacts cash-strapped leaders can have.